Great way to motivate service providers. The problem is that if their compensation depends on selling particular products, then that's what they're going to want to do. Sometimes financial advisors get paid more for recommending some products instead of others. Sometimes commissions can be hard to spot. You may have heard the term load charge, for example. Some mutual funds and insurance products have a fee built right into their cost. That's a load charge. Sometimes the load is listed and sometimes it's not. When in doubt, ask if there's a load charge. The second way that advisors get paid is through an hourly fee. This approach eliminates the incentive to push high commission products, but I'm sure you see the downside. You can't monitor the actual hours an advisor works. You're going to have to take the advisor's bill on faith. Advisors on retainer, the third way to get paid, charge an annual fee based on the amount of work that the advisor expects to do during the year. One obvious risk is that for one reason or another, you may not use the services the advisor offers. In that case, you've wasted the retainer. Another potential problem is that you might not get the service you expect. After all, the advisor gets the same fee no matter how hard he works. True, a lazy advisor will soon lose his customers, so there's a limit to the amount of shirking that goes on, but still, it can happen. Finally, an advisor can get paid a percentage of assets under management. Like the other three forms of payment, these fees can be all over the map. Most will be between 0.25% and as much as 2%. The bad part of this arrangement is that an advisor who handles $20 million doesn't work twice as hard as a guy who handles $10 million, and he doesn't have twice the expenses either. You'd think that some of those scale economies ought to sift down to the investors, but that doesn't seem to happen too much. The good part of it is that it motivates managers to produce for their clients. If they do, then you'll have more money to invest with them, and they'll attract more investors with more money. Their compensation goes up accordingly. Unless you're going to go with a bare bones brokerage account that doesn't offer anything beyond transaction services, then you might want to develop an investment policy statement. Ideally, you'd do this before you formally agree to become someone's client. That way, you'll get a much better feel for whether you have a fit. If you think you have your guy or gal already, then it's a good idea for the two of you to develop it together. An investment policy statement, or IPS for short, is a roadmap for your investment program. It ought to include the obvious stuff like your investment objectives, but after that, it can have just about anything you want in it. For a passive investor who makes his own decisions, a formal IPS isn't necessary. The more active management you want, though, the more you'll benefit from an IPS. I like the idea of including accountability in an IPS. Who is going to do what? Will you make your own investment decisions, or will the financial advisor? What documents will you receive? The IPS ought to state what constitutes a permissible investment. If you think you're a conservative investor and are new to investing, then you might want to limit the advisor to purchasing stocks and rule out other financial instruments. At the other extreme, you might be willing to let them trade just about anything on your behalf, except for a short list of excluded items. Maybe futures markets and foreign exchange trades are too esoteric for you. If so, then rule them out. Do you want to borrow funds to buy more stock and to increase your equity stake? That's risky because it will magnify any losses, but if the stocks appreciate in value, then you'll make lots more money. I also like the idea of mentally tying yourself to the mast. Remember Odysseus? He had his crew tie him to the mast of his ship so that he wouldn't succumb to the siren's seductive voices. That's a good strategy for investing too. Decide now, before the fact, how you'll respond to good and bad outcomes. What do you want to do if your portfolio falls 20%? You can invest more, or you can sell some shares, or you can do nothing and just ride it out. But it's better to decide now in